Hey everybody, Abdullah here. Today we'll be going through the financials of a popular stock within a hot industry. The market's really been into the EV industry as a whole. We'll be going and discussing NIO, the electric car maker out of China. If you aren't subscribed to my page, make sure you hit the subscribe button below. Hit the like button so as many people as possible are able to see these videos, and leave comments with your thoughts, whether you agree or disagree with what I share. Additionally, please sign up for my Patreon. The link is in the description below. You'll get insight into my watch list, my portfolios, live updates on stocks that I'm researching on based off of my daily readings, and then instant posts when I make stock buys and sells each day. We'll be going through NIO's balance sheet, income statement, and statement of cash flows. This will give a high-level overview of their current state from a financial perspective. Those three statements have everything you need to know. There's always the footnotes to the financial statements, which give further clarification on the specific numbers in each of those statements. However, we'll just be doing a high-level overview. Always have other opportunities in the future to be able to go into those details. Just looking at NIO's graph, we can see that NIO's made a huge run over the past year, trading at a low of about $2.40 or so, and we can see here $2.11, and now with the high of $66 over the past 52 weeks. Has an incredible run. In general, the EV market has been very hot. Renewable energy, governments have been pushing it, pushing states as well as the country as a whole to be carbon neutral or moving to all electric by a certain date. So this has pushed all the EV stocks as well as renewable energy stocks in general. We're going to now analyze the financials of NIO and see if it's justified, whether the company can sustain, whether it's going to continue to grow, etc. So let's get to it. So we're going to go to the financials. First, we'll go through the income statement. We'll go through the last 3 years. We can see the companies increased their revenues. Keep in mind, all of these numbers are in Chinese yen, and they're also in thousands. So we're looking at billions of dollars in Chinese yen here. Total revenue was 7.8 billion Chinese yen in 2019 versus 4.9 billion the prior year. We can see here also from the cost of revenue that they're selling their cars at a loss. It was almost break even in 2018. However, that loss increased in 2019. And so we can see that their gross profit, or their revenue minus their cost of revenue, is negative in both years, and it's increased as of the end of 2019. We'll later go into the quarterly financials. You can see their expenses have been consistent, which is a good sign. Overall, their operating income, or income from their operations, is a negative, and it's increased over the 2 years. One thing that people will point to is that their net income is better in 2019 versus 2018. But from here, we can see that all of that was related to specifically taxes. They might have had some tax incentives or something that they were able to capitalize on in 2019. We'd have to look in the notes to the financial statements related to that. However, we can see that their operations actually, from a pre-tax income perspective, was actually worse in 2019 versus 2018. Now, if we quickly flip to the quarterly financials, we can see that the company was negative as of Q1, and then they slowly started to become positive as far as their revenues minus their costs of revenues. So they're getting better from that respect, and they're starting to generate a profit from the sales that they're from their car sales. In addition, there's economies of scale. As you continue to grow and build more and more cars, you're able to sustain better margins because of the numbers you have, and some of the potential costs that you were incurring, such as like building a factory. Those are fixed costs, so they don't increase. And when you increase the quantity of cars that you have, then you're able to start realizing profits. So they're able to start becoming more profitable in their sales, but we can see from a pre-tax income perspective, they're still losing about 1 billion yen per quarter throughout the year. It's gone less and less over each of the quarters, so they are improving. However, they still have a long ways to go to try to become profitable. So that's the income statement. Next, we'll go to the balance sheet. We can see from a balance sheet perspective at the end of 2019, the company was in a bad spot and their assets were lower than their liabilities. And then if we specifically go to current assets versus current liabilities, they were actually in a negative 5 billion yen position, which is not a good state to be in. You always want the current ratio, which is assets over liabilities, to be greater than 1. If we go to the quarterly financials, we see a slight improvement because of the company's stock run. They were able to generate some cash and raise some money. So we can see a significant increase in their cash from 10 billion in second quarter to 22 billion yen in the third quarter, which is something helpful for the company, and they're able to have more cash so that they have runway to continue to build their business. Finally, we wanted to go through the statement of cash flows. I always like looking at this to be able to see the pure cash that the company is able to generate from operations. There's a lot of things that go through the income statement, whether it's one-time charges, equity method investments, different things that, because of the accounting rules, it makes the net income number less informative of how the company is doing. So that's why a lot of people, for example, Warren Buffett, he'll always say to go and look at how much income is generated from operations, because his net income is always going to have other numbers that either inflate it or deflate it, depending on how his equity securities are doing in that specific quarter. So our income from operations is always a better number to look at, and always looking at, again, operating cash flow. In this case, we can see the past 3 years, the company's used negative 8 billion yen. Past couple of years, about negative 8 billion yen. And then in 2017, negative 4.5. The company's obviously growing, so they're using more cash in their operations. But we could see that in the last balance sheet, if we flip back, they have about, when you go look at the quarterly financials, they have about, and their assets 26 or 22 billion yen in cash. And then from the cash flow, you can see they use about, you go to the annual, we can see they use about negative 8 billion yen. So they have about 2 to 3 year runway with their cash, which is great. They're able to generate the cash. However, they need to be able to continue to grow their business. They have many competitors in China, one of them being Tesla, and their niche is specifically in China. However, Tesla, as we know, is able to sell throughout the world, specifically the United States and Europe, and they continue to build additional factories. So highly competitive area. NIO has a tough competitor in Tesla. They really have to be able to innovate and continue to be able to push and penetrate the market in order to be able to compete with Tesla. As we mentioned, the company's been able to raise cash in order to sustain operations for a couple more years. However, they need to work towards building a more profitable business. The comparison to Tesla doesn't work because Tesla has become more of an energy company with their gigafactories, battery technology, and solar businesses. As a result, the market has priced the company as such. Whereas in NIO's case, the company is a car maker and currently is limited to such. NIO, I'm sure, is working towards making strides in these other areas as well, just like Tesla has over the past few years, but is much further behind in majority of the markets around the world. As we have seen with other Chinese companies like Luckin, who try to compete with Starbucks, it's hard to catch up with the bigger player in the industry unless you're able to considerably differentiate. I don't see that with NIO. I've stayed away from the stock. It has had a good run over the past year, but just like Luckin did a year ago, they had a great run, but I don't think it will last. Those are my thoughts. Let me know your opinions. As always, make money, enjoy life. Peace.